Hi learners, Professor Joe here. In today's session, we are going to learn about short call options. So let us see under what market circumstances should you sell an option and earn money out of the premium that you receive. In the previous video, we discussed about long call option. And if you have not seen the video, please go ahead and see that video because that will help you to understand few of the concepts that we'll be talking in this video too. So let us continue under what circumstances or under what market conditions you should go for a short call option. Now a trader want to enter a short call option in multiple conditions. Number one, if the view of the market is bearish. Number two, if the view of the market is sideways. And number three, if the view of the market is sideways and might go a little bit up before the expiry. But 101% the view is not bullish, that the market is going to go up, straight up. In a short call option, the maximum profit that a seller gets is the premium that they receive for selling an option. That is the maximum profit a seller can get. Now, it is not every time that a seller will get the maximum premium as profit. There are multiple conditions that you need to understand for it. Also, like all different options, a seller of an option also have multiple choice at what strike price to go for the sell, whether they want to go with the ATM strike price, whether they want to go with ITM as strike price, or whether they want to go as OTM as strike price. Before I get into a short call option, this is one question a lot of my learners ask me. Sir, when you don't have something in your hand, how are you able to sell it? So first, let us understand the concept of short selling. Now, you are a seller and you have a view of one particular financial instrument that it is going to be bearish in the coming future. The price of that financial instrument is going to go down. Then as a seller in the stock markets, you can borrow that financial instrument from your broker. Yes, you can do that. So say example, you borrowed 1 lakh units of one financial instrument, and then you went to the market and you sold it for say 10 rupees. Now, the expiry can be for a week or for a month. Say, let us take an example for 1 month. At the end of 1 month, you have to give this 1 lakh, whichever financial instrument you have taken from the broker, you have to give it back. You just have to give the instrument. You do not have to worry about the price when you're giving it back to the broker. But you have to worry what is the price in the market, because now you sold that 1 lakh units at 10 rupees. That means you pocketed 10 lakh rupees, 1 lakh into 10. Now, if the price falls down, say to 5 rupees, at the end of the month, you buy back those financial instrument at 5 rupees, give the financial instrument to the broker, and you have earned a profit of 1 lakh into 5 rupees, that is 5 lakh rupees. But the problem is if the price goes up, and there is no limit for the price to going up. It can go up to 100 rupees, it can go up to 1000 rupees. And if the price goes up to say 100 rupees, you still have to buy those 1 lakh units of the financial instrument at 100 rupees. That is, you hit a loss of 90 rupees behind each unit, which is a huge loss because you still have to give the financial instrument at the end of the month to the broker. That's why they say in short selling, there is unlimited risk because the price can go up how much ever it wants. But in options, you have a facility of putting a stop loss. So you can avoid the circumstances when you are a seller in the options market. I hope you have understood how a short selling transaction happens in the stock market. Okay. So now let us come to short call option. Now this is a diagrammatic representation of a short call option. Like you can see in the diagram, remember I told you last time, the vertical line is the profit line. So once the curve is below the zero line, now where is the zero line? Where you see the line of the price. On the left side, the price is at the lower side, and on the right side, the price is at the higher side. Now if the curve is above the zero line, that means the option seller is in a profit. And if the curve is below the zero line, that means the option seller is in a loss. Now, in this diagram, you can see that how much ever the price goes down, the option seller profit does not increase. It remains constant. But between the strike price and the break-even price, the profit is reducing. And as the price goes higher, the loss of the option seller increases. But as I told you, you can put a stop loss in the options market. That is the facility you have between theory and the real market. This is one additional thing that you can protect your downside by putting a stop loss. Here in this diagram, you can see that how the profit keeps reducing between the strike price and the break-even point. And once the price goes higher than the break-even point, remember I'm saying higher than the break-even point, the loss of an option seller increases. Or when I say option seller, short call option seller. Okay. So you can see over here at the strike price, the profit is 10. As the price increases, the profit reduces to 8. As the price increases further, the profit reduces to 6, 4, 2, and 0 at break-even point. And as the price keeps growing higher, the loss starts accumulating. So you can see -2, -4, the loss is increasing over here. So this is just a diagrammatic representation which you need to understand if you want to make your career in options. Now, in a short call option, as I said, the option seller's view is bearish. That means the price has reached one level which you think is a resistance level, like you can see in this diagram. And you feel the price might be around that level for some time, and then it might gradually come down towards the expiry date. The vertical line is the expiry date. So if you're sure about this, or if you think that this is how the market is going to perform, then you can sell options, that is go for a short call option and make money out of the premium. 3 strike prices. As I told, you have 3 strike prices at which you can enter, which is ATM, ITM, and OTM. Now, where do you get these? I hope you still remember, you get these pricing in the option chain. This is how the option chain looks. The left side is the calls, the right side is the puts. Since it's a short call option, you will get your last traded price in the calls side. Okay. It's very, very important that when you are entering into a short call, you have to be very, very clear under what market circumstances you are going to enter. So either the market is going to go bearish, or the market is going to go sideways, or the market is going to sideways and a little bit up because you feel there is another resistance level. So you think that the market might go sideways and max it can go up to the next resistance level. You can enter at different strike prices, ATM, ITM, and OTM. Now remember, the goal when you are selling an option is to pocket the entire premium. How you can pocket the entire premium is the market remains below the strike price. But there is one another way how you can pocket the entire premium, that is on expiry date. The decay of premium is a friend. Expiry date is a friend. So if you think that the price is not going below the strike price, but it is somewhere between the break-even and strike price, then stay till the expiry date, because once the option reaches the expiry date, it becomes worthless and the option seller can pocket the entire premium. Isn't it interesting? So as the day reaches close to the expiry date, the value of the short call option becomes 0. Yes, it becomes 0 and you can pocket the entire premium. These are the situations in which an option seller makes profit. Number 1, if the price is below the strike price, the option seller keeps the premium. Number 2, if the price is between the strike price and the break even, then the option seller gets to keep the premium, but not the full premium. Depending on where the price is, some part of the premium goes off and the balance remains as profit. And the third way that an option seller can make profit is on expiry. If the price does not move too much heavily on either sides, towards the end, that is on the expiry date, the premium will become 0 and the option seller gets to keep the premium. premium. So under these three circumstances, a short call option seller makes profit. Now, as I told, if the price goes up, there is unlimited loss, but in options, you have an option. In an option, you have an option of putting a stop loss. This way, you can avoid unlimited losses in a short call option. So as I said, in a short call option, the expiry date is your friend. If the price is not moving, then towards the expiry, the short call option will become zero and the seller of the option gets to keep the complete premium. Towards the expiry, you thought that the price is going to remain close to the resistance level and it remains like that the way you thought. Because of your experience, you can predict. It's not necessary every time your prediction will be right. In summary, short call option is a wonderful option tool you have if you think your view is bearish about the market, or if you think the market is going to remain sideways till the expiry date, or if you think the market is going to remain sideways and might go a little bit above your strike price till the expiry date. In a short call option, the expiry date or the decay of premium is your friend because it allows you to keep more and more premium in your pocket. I hope that with this video, under what market circumstances you should go for a short call option is pretty clear. Keep looking forward for my next video where I'll be explaining the other two basic strategies of options. I have also written a book which is available on Amazon Kindle. The name of the book is Traders You Can Win, but First Learn to Lose. It's a wonderful book for new traders who are just entering the stock markets. Till then, keep learning, keep growing. If you love the content that I am creating, please like and share. And for more such videos on finance, options, technical analysis, fundamental analysis, and even personality development, kindly subscribe to my channel. Thank you very much. Namaskar.